The conventional wisdom is that as you get older, you reduce your stock portfolio and you buy more bonds. And there's this old rule of thumb called the rule of 100, where you subtract your age from 100, and that's the percentage of your portfolio that should be in stocks. And it's a terrible rule. And we will have another episode completely about that. But the idea here is that as you get older, fewer stocks, more bonds, which means lower returns, right? Because historically stocks have higher returns than bonds, but they also have more volatility and risk. Another rule of thumb here that, again, we're going to totally put a stake in is the 4%. And a financial planner named Bill Bengen came up with this back in the 90s, where he basically found that if you withdraw 4% of your nest egg in the first year of retirement, and then you just adjusted that withdrawal amount upward every year after that by the inflation rate, then your portfolio should last you at least 30 years. But a 4% withdrawal rate is not so much fun. Denny, if you want $40,000 a year from your portfolio in retirement, $40,000 a year is not a whole lot to live on, right? We're not talking about a lot of money. You'd have to save up $1 million for a measly 40 grand a year in retirement.
Which isn't even that much to live on.
Yeah, that's not a ton of fun.
No.
So where this gets interesting is that even Bill Bengen himself, the guy who came up with this rule, nowadays, he actually says most people can do better than that. Most people can actually withdraw 5% or more from their portfolio every year if they do one thing differently than the conventional wisdom. Now, before we get into how this works, we should give you a quick background here on sequence of returns risk, because you need to understand this risk. Everyone actually really needs to understand this risk when they're talking about retirement planning.
What does that even mean?
I know. Well, yeah. So it's when the market crashes happen, right? There's always going to be volatility in the stock market corrects, it crashes. This is what it does. When those market crashes happen, actually has just as much impact on your stock portfolio as your average long-term returns on your portfolio. So a stock market crash really early in your retirement is devastating to your portfolio because you end up having to sell off more stocks in order to generate the same amount of money to live on while the market is down. But if you do that, if you sell off too many stocks, then even when the market recovers, you've gutted too much of your stock portfolio for your portfolio to ever really recover. So that's the risk here, is a stock market crash really early in your retirement. So how can you handle this? You can handle this by doing what's called a U-shaped stock portfolio, where yes, as you approach retirement, yes, you do sell off some more of your stocks. And then you have more of your money in real estate, in bonds, in cash when you first retire, when you're at that most vulnerable point in your retirement. And then once you get past that hump, where you're past the danger zone of sequence of return risk, then you can buy back more stocks and you put more of your money back into stocks because stocks earn so much more,
Now, does
higher
this all
returns.
work even when recessions and all that stuff happens? Is this process going to still protect?
So this is actually specifically designed to protect you against recessions. So what you don't want to have happen is to have a recession and a big stock market crash happen right when you retire. So you sell off a whole bunch of your stocks before you retire so that you have a very small stock portfolio at that point. And you go through the first few years of retirement with a very small stock portfolio, and then you can start moving your money back into stocks. You can start getting rid of some of your bonds and your cash holdings, move those back into stocks for the rest of your retirement so that you're earning higher returns on your portfolio throughout most of your retirement, just not in that super vulnerable first few years of retirement.
Now, let me ask you this, though. That's a lot of work for some people to keep an eye and have to do it. Is there somebody that can handle all this for you?
Yeah, you can talk to a certified financial planner or an investment advisor or some other kind of wealth professional to help you with this. But this doesn't have to be hard. You can, instead of dropping your stock portfolio to 40 or 50%, maybe you drop it down to 20% just for the first few years of retirement, and then you bump it back up to 40, 50, 60% of your portfolio. Real estate can also help with this. So I invest in real estate instead of bonds. You do you, right? You're responsible for your own portfolio, of course, but you can earn higher returns on real estate than you can on bonds, including some relatively low risk real estate investments. So there's a lot of things you can do here, but the point is that you aren't stuck with this low 4% withdrawal rate in retirement. You aren't stuck with having a declining percentage in bonds in your portfolio throughout your life. You can sell off a lot of those stocks right before retirement, go through those initial high risk years, and then buy back into bonds as this U-shaped
Hmm,
portfolio curve.
that's pretty cool.
Yeah, and to keep your living expenses low in the first few years of retirement when you are living on cash savings or bond interest or rents or interest on real estate investments, you could go live abroad for a few years. I've spent the last 10 years living abroad and cost of living is way lower. Go have an adventure. Live off of your cash for a couple years, live off your bond interest, live off your real estate income. And then if you want to move back to the US, have higher living expenses, maybe that's a great time to put some more money back in stocks, earn those higher returns again. Anyway, Denny, any final thoughts on the U-shaped stock portfolio before we call this episode complete?
No, I think it makes total sense. I think it's interesting because couples can have completely different ideas on this, and I'm closer to retirement than you are, and my husband's very much into stocks, and I'm very much into the passive real estate investing. So it's just funny to see the difference, and that's all over. Everybody has a difference of opinion. So
Yeah, and
it's
it's
good.
not either or. And part of the beauty of this U-shaped stock portfolio is that you get to buy back into stocks after just a few years and have a much higher percentage of your portfolio be
Right.
in stocks than the typical retiree does. You just have to get through those first few dangerous years of retirement. And you can replace bonds with real estate in your portfolio entirely if you want.
Right.
Earn higher returns there too. So all of this is designed to help you have a higher withdrawal rate in retirement, have a better quality of life, be able to pull more money out of your nest egg in retirement than what the typical 4% rule would allow. So anyway, if you got a first perspective from this episode, subscribe on our YouTube channel, subscribe to this podcast, and pay it forward. Pay it to people, pass it on to people who might get a kick out of this, might find this an eye-opening financial lesson that they hadn't thought about before. And if
Right.
you didn't get anything out of it, email us and let us know why. Support@sparkrental.com. Let us hear what you want to hear more about moving forward. Let us know what you want us to talk about, what assumptions you want us to burst in the personal finance and investing space. And lastly, consider joining us in the co-investing club. We have a free course on how to invest passively in real estate. Check out sparkrental.com/free. And Denny, any final thoughts?
No, I just also, if you want a free course, there's a free course. If you go to, oh, you just said that, sparkrental.com/. No,
All right, guys, stay weird, unconventional investor.